to jump into a conversation about property insurance, insuring tomorrow. What's next for those things? If you own commercial real estate, you've probably had changes to your policy recently. Change to wind and hail, change to the way that your deductible is structured. What does that mean? Should I explore a collective captive or something along those lines where I can decrease the costs, create more predictability for myself, pay myself back into my balance sheet? There's a number of options. And our next speaker, Jerry Messick, is going to uncover how we should go about looking at these things and how we should underwrite for that in the future, and what controls do we have as we look at property coverage in the future. So, Jerry, could you please join me out here on stage? We are so excited. Let's give it up for Jerry Messick.
Thank you, and good morning, everybody. Michelle? Yeah. Now? You want to hit it? Insurance? Oh, thank you. So I'm Jerry Messick, and I'm here to talk to you a little bit this morning about the insurance industry, specifically for property, but I want to talk to you a little bit more than just property insurance, right? Because I think property insurance has gotten caught up in quite the craziness that we find ourselves in right now. And I'm sure most of you panicked a little bit last night when you crawled back from the bar, walked back from the bar, however you got back from the bar, and you realized that Messick's talking about insurance. So you probably got into your computer, you broke open your 289-page property policy, and you went through it, right, in anticipation for some questions today. Here's how I know that you're lying to me if you did that, right? Anybody know what the nation's #1 best-selling unread novel is? Right? Yeah, it's your insurance policy. Nobody reads them, and I get that. Even if you have a claim sometimes, nobody reads them, right? Call the attorney, let the insurance company deal with that. So when Ben asked me to come talk, I wanted to explain how we got here, where I think we're going, okay? But most importantly, what I really want to do is I want to educate you on some options. It doesn't matter what size you are, okay? I'm an alternative risk financing person. That's what I do. I specialize in the creation and management of captive insurance companies, and I've been doing that for 41 long years, okay? Then, unfortunately, that means we get to talk about some loss ratios. I'm going to show you some pretty pictures, not a lot of numbers, but I want you to understand what's driving this. And Charlie, I don't know if he's here or not, he hit on it in the earlier presentation this morning, okay? So I want to introduce you to something called cash flow underwriting, all right? And it's something that's been going on forever, all right? This is a loss ratio chart for the past 52 years, right? Now, what makes this interesting is I call it historical stupidity, because the underwriters keep doing this and expecting different results. You see the peak right there, right? That's because people were panicked. They raised premiums, right? They raised deductibles. They cut limits because their loss ratios were climbing. Their bosses were freaking out, okay? Inevitably, they get up past the peak, okay? And then we head back down again. What happens here, right? More panic, because new capital came into the market on the peak. Charlie called that liquidity. More liquidity comes into the market, and he's right, okay? And they've been doing this forever, right? Let's get into the business of insurance. New money comes in, right? Until what? They hit the bottom and the loss ratio starts to climb. And we are on this roller coaster, right, for years, and it just keeps happening. What I want to show you with this is the gap between those peaks, all right? And I want to tell you what I think is driving the shortening up of that, okay? Look at it. You see how wide those peaks are, right? But something happened in the year 2000, okay? Things started changing a little bit, right? Those peaks started getting closer together, okay? And closer together. Now, we had a fake one there and it widened out a little bit. But this is 18 years of experience that I want to talk about this morning to show you where we're at right now, okay? This next slide, I think you may have seen before in a different presentation. These are billion-dollar events, okay? Going back to 1980, right, to 2024. So it's picked up that extra 6 years that we didn't have in the loss ratios. On the left, numbers of events, billion-dollar loss events. On the right, the cost, $600 billion for those years, for that year, right? Now I'm going to superimpose here the 18 years. Do you see what's happened? We were going along fine, all right? Underwriters were peaks and valleys. They were broad, right? It's called the cycle of insurance underwriting. Until we hit about 2000, 2004. Then it started picking up. I didn't make these numbers up, right? I'm not going to call it global warming. I have no idea. But it's shocking, right? The number of severe storm counts in the green, right? Those are convection storms. Hurricanes, winds, high winds, straight line winds have become a recent phenomenon, right? I'm from Oklahoma City. We just had a tornado hit Ada, Oklahoma last night, early March, okay? I don't think this is going to change. I hope it does. But is it the new norm? And underwriters, when they price your risk, they don't know what's going to happen with your risk until years down the road, right? Now, property claims can happen like that, and you typically know when you have a property claim versus a liability claim that can take, on average, 2 to 4 years to settle, okay? Here's the result, and this is kind of what Charlie was talking about with the liquidity also. Now, this is all property and casualty, okay? 25 consecutive quarters of rate increases. The reason that Charlie can talk about 30% decreases is because of that, right? All of those increases over time, 25 consecutive quarters, right? Mind-boggling. But this is the reaction that we get when underwriters don't understand the risk that they are writing. And for a very, very long time, property insurance was priced so low, right? And I do agree with him. I think good accounts in good areas are going to experience some pretty significant declines in their premiums. What about the rest of us, right? Those of us in hail country, wind country, etc. We've got a lot to look at. But why am I using commercial lines history and not property specific? Because as long as you pay large commercial insurance carriers whatever lines of business they write and wherever they write it, that means your premiums are going to be used to pay those losses, right? I don't know of an exclusive property insurance company that only does LA County, right? So it doesn't matter. Hurricanes, right? Tornadoes, floods, wildfires, hail, wind just about everywhere, right? And don't forget liability claims. So you keep paying the premiums, right? And they're going to use those premiums however they see fit, right? And normally it's to pay someone else's losses. Don't get me wrong, insurance companies serve a very valuable purpose, right? Especially when you have lenders involved. But even if you have a carrier, okay, that doesn't write coverage for hurricanes or floods, I bet their reinsurers do. And Charlie mentioned earlier about the reinsurers. I'll give you an example. For the fires in California, it was just reported 2 weeks ago that sucked up 35% of all reinsurance capacity in Europe. Just those events. Okay? Again, while I think that cherry picking certain accounts, they're going to have a benefit of a reduction in premium because we've had so many years of increases, right? But I really want to talk to you about some options, and that's really what I want you to carry away. It doesn't matter what size you are, right? While I have a specialty in captive insurance companies, captives aren't a panacea. They're not an answer to everybody, right? And we'll touch on those in just a minute. How do we gain control over this? I don't think we can control the weather, right? And as fun as this has been, it's just not worth it, right? I don't bring this up at the table anymore. But you can't control your operations. And if you can control your operations and you can do things to enhance the value of those operations from a safety and risk perspective, you can control your insurance program. I'm going to need you to think outside the box, though. So I'm going to ask you this question. Are you a buyer of insurance or are you a seller of your risk? What's that mean, right? Buyers of insurance, usually they get their renewals 2 days before the renewal date, right? The brokers apologize. I get it. And you'll find out I'm not a broker here shortly. But they serve a good purpose as well if you've got a good one, right? Buyers of insurance worry about their spikes at renewal. Sellers of risk, the options that I'm going to talk to you about today are for sellers of your risk profile, okay? Not buyers of insurance. So let's look at some of these options. And we'll drill down on some of them. Again, some of these might be applicable to you, some might not. Some of you may have already taken high deductibles. Show of hands real quick. Who's had to raise their deductibles in this market? Just because the premiums weren't sustainable. You had to look, that's right, you had to look at different options, okay? And we'll talk about some of those. Stop paying your broker a commission. I ask this question with every account I work with. Are you paying your broker a commission or a flat fee? Well, Jerry, I'm not really sure. I don't really pay him anything, right? The insurance company pays them. Do you remember the 25 quarters of increases? That means that your broker has gotten a raise every time you felt pain. I don't understand that model. Never have, okay? Look at it where it's legal. Call your attorney first, and then you can call your broker. All right? It usually is about 10 to 15% in commission. That's a big number, okay? Fees are usually 4 to 6. It's almost like buying at wholesale versus retail. That doesn't count contingency fees. Are you familiar with contingency fees? Those are clauses in the agent's contract with the insurance company that says this: if your book of business has below a certain level of commercial loss ratio, I'll pay you a bonus. I'll give you an extra 2% on the whole book of business. Those can add up. If they're not disclosing those to you, they should. Ask them about it. Become a seller of your risk. Understand what drives your premiums, okay? These are most common, though, with spend above $750,000. Now, I've seen it as low as $300,000, okay? But usually, because the premium gets up there, the commission, it just doesn't make sense. So think about that. And here's something I really want you to think about. Make them provide you the last 5 years or longer, okay, of premiums by line and losses by line of business. Property, general liability, it doesn't matter what line. I want to know what my history is, okay? We have a saying, what gets measured gets managed. If I'm not looking at that, I guarantee you the insurance company is, because that's what they do. They look at loss ratios historically, okay? Make them work for this. Have them develop that story, okay? And position you as a seller of your risk, okay? Not just a buyer of insurance. And you're going to be amazed at the results that you get, okay? Two, mitigate. You know, this is something that should be applicable for everybody. And I get it. The CapEx, the OpEx, what you're spending on insurance is a killer. All right? And it doesn't leave a whole lot of room for improvements. But inspections, right? It becomes a state of mind that ultimately becomes a culture. They say that there's no better law enforcement when you're driving a car than a policeman in your rearview mirror, right? That's what you have to become. Boots on the ground inspections, unannounced, to your locations will ultimately drive results. It's accountability. Tie claim results to their pay, okay? Seller of your risk. It's driving a different paradigm. It goes with facility maintenance, right? Take care of it. Here's what I want you to do. I want you to go back, and if you haven't already done this, I want you to find out who is a specialist, right? Who handles the types of claims, right? Property, liability in your area, who your insurance company is going to call if they have a claim. And if that attorney is not local, you have the wrong insurance company. Okay? I don't want somebody out of New York or Chicago handling my claim. I want someone local who understands the market, who understands what type of claims and how I can work against those type of claims. Call them, get to know them, okay? Because the best claim, right, it's the one that you don't have. And you really can control that, okay, over time, and it does take time and effort. Okay, empower somebody in your organization to embrace this paradigm shift. Okay. Now we're going to get into a little bit more detail on some of these other options. And again, some of them are going to be applicable, some of them not. Higher retentions and deductibles, yeah, we get it. But on property, small claims don't move the needle. The days of the $5,000 and the $10,000, unless you're willing to pay for that, are really gone, okay? Your own homeowner's policy, wind deductibles, high deductibles, they don't want to pay for roofs anymore, right? Commercial insurers are the same, all right? They don't want to do that. 45 to 55% of your premium spend goes to pay for claims in that $1 million, that first $1 million limit. That's why $5,000 or $10,000 just doesn't move it. Okay, look at 100 or 250 or even 500,000. Now I get it. Those are big deductibles and they're not going to be applicable for smaller owners. I get that. But look at what you can embrace and take. Okay? Look at that and consider a basket aggregate. Now this is an actuarial term. Maximum probable loss. Okay? Not maximum possible loss, that's total insured value, right? But maximum probable loss. And only an actuary can tell you that, okay? And again, this could be a lender issue. High deductibles can be a lender issue, but there are options for that, okay? This also gives you a war chest if you'll open up an account and put the money for your deductibles in it. I know it ties up money. Ties up capital. But the last thing you want is a surprise on your balance sheet when you do have that claim, because you will have that claim. It's inevitable. You're going to have the claim. Fund for it. Develop that culture of funding your risk. And eventually you'll have a war chest that will give you even more flexibility down the road. Okay? Caveat, right? Obviously, if you finance, you're going to have lender requirements. But when I get to the next option will apply to this one as well, okay? Because you can use a front company that takes absolutely no risk, but gives you a policy, and on that policy, it will have a zero deductible. But it is an AM Best, A-rated insurance company that gives you that policy. They're going to charge you a fee for doing that, but they're not going to take a single penny of risk. Let's look at that. This is usually consider going big. Very large deductibles, especially if you can talk your lender into doing it direct. Do it direct. Don't get a fronting company. Don't buy that policy back down. Use your balance sheet to do it. And if you can convince your lender to do that, that's even better. Okay? But I'm talking about retentions of 1 million, 2 million, 10 million aggregate for all locations, right? Paid or incurred retros. Anybody ever heard of a retro program? Okay, I'm not going to go into it. Call your broker. Call me. I'm not going to sell you one because I'm not a broker, but I can educate you on it and what you ought to look at. Okay? Create a working claim fund just like you did on the previous option, but it's going to be based on an actuarial report. These are big retentions. Don't gamble with that, thinking that just because I have $500,000, I put $500,000 in and I'm good. Okay? Because it's a multi-year exposure that we're looking at. Anybody know the difference between those two terms, self-insured retention and deductible? Right? You have $1 million limit, you have a $100,000 deductible. The deductible sits inside the limit. It creates a credit risk for the insurance company versus a self-insured retention that puts that limit on top of the retention. They will not drop down. That creates no credit risk for them, and it lets you handle the claims on that self-insured retention. You can do that with $50,000 SIRs or 100,000 SIRs. It's a different way to fund your risk. Again, only works, right, if you've got the lender or you buy a drop-down, a fronted buy-down program. This is a little bit more technical, right? This is usually for the bigger accounts. The exception is group captive. A lot of you may have gotten an email from Ben looking for some data, because I think what we would like to do is look and see if it makes sense for a group captive with this group. Group captives are usually designed for anybody paying anywhere from $50,000 up, okay, to $1 million, all right? But they're not for everybody. They take very high retentions. You buy them back down in the captive. The most important thing is it allows you direct access to the reinsurance market, right? And that's buying wholesale. The expense ratio for a retail company averages between 35 and 45%. That money is gone before they even have a chance to pay the claim. You can pull that information up on your insurance company online, find out what type of expense ratio they have, okay? They can reinsure an AM Best fronting company to meet lender requirements. The captive is never seen. It's a reinsurance company. All you get is a piece of paper, right? It provides stability, the ability to include other lines, tenant legal liability, security deposit programs, right? We do a lot of those, okay? Have your tenants fund your insurance company, okay, if you're large enough to do it, okay? Now, I know I've thrown a lot up here, and what I want you to do, you can take pictures, whatever, you can download this, all right, from the app. Take it back to your brokers. Talk to them, right? Sit down with them and say, I'm tired of paying this premium. What can I do? All right? And they will come up with some solutions, okay? And it allows you to stop throwing money over the fence, because the only way for them to throw it back is if you have a claim, okay? Take control. You guys have been great. Now go read your policy, all right? Thank you.